everybody's doing well. My name is Clayton. I'm the primary portfolio manager and owner of Centurion Growth, our business consulting and asset management firm for businesses. And I am the owner and run the live calls, daily live calls, Monday through Friday for Centurion Education Group, our multi-platform financial literacy company, where we help individuals daily go over everything that they would need to know in the stock market to outperform the market and produce income and returns that they'd like to see month over month, year over year. So that's me.
And I am Joshua Stauffenberg. I am the Chief Operations Officer of Centurion Group. Today we're going to be discussing a very much asked for and anticipated video of the wheel strategy and how to go about trading it. So first and foremost, I think this goes without saying, but what is the wheel and what does it entail?
All right. Well, the amount of times I get this question, I'm just very happy that we're now making a video for this so that every time somebody says, Clayton, what is the wheel? What does it entail? What's a covered put? What's a covered call? Well, now we've got the videos for all of those questions and they are answered in full. Whether it's through me showing my computer and my trading platform to go in detail of what I'm doing, or us talking about it and you asking me questions that I get on a daily basis.
Absolutely.
From lots of people. So, what is the wheel? The wheel is a strategy, an options-based strategy that also utilizes shares of stocks or ETFs that brackets both the upside and the downside so that you can profit whether the stock goes up, down, or sideways. Doesn't matter. The wheel is also an incredible way to capture short-term moves in a stock. You can do it short-term, you can do it long-term, whatever you so choose. But it's a great way for me to really capture with a percentage of my portfolio short-term explosive moves, either to the upside or to the downside. So what does the wheel entail? It entails capital for shares, and then capital for covered calls and for covered puts. So we, and both in the most recent videos, we covered covered calls and covered puts. So please make sure you watch those videos so you have a better understanding of what covered calls and covered puts are. I've gone into the best detail I possibly can, but if you do have questions, I speak live in our Discord and through multiple platforms which I share this content through to make sure that you guys have the most thorough understanding of what it is that we are doing. So that is the broad brush stroke. And I know you do have more specific questions.
Absolutely. So I guess next off would be, how do you personally go about implementing this strategy within the market on any given day, right?
Absolutely. That's a great question because then again, we get these questions every single day. So I want to make sure that they're answered. So on a daily basis, the first thing that I need to find is what do I want to run the wheel with? And for me, that is a handful of ETFs. I do not use individual securities because I would not run the wheel with anything I would not want to hold long term, period. Period. There might be some enticing opportunities with stocks that are volatile that might produce good premium or might have good upside, downside, good volatility, etc. I don't care. If I need to say that again, I will. I don't care. I use ETFs because I will hold them long term and I have no problem holding S&P and NASDAQ based ETFs for years, let alone a few days or a couple weeks. Okay? So, from start to finish, I need positions that I'm willing to hold and that I'm willing to trade and that will produce me a good return.
Right, of course.
Right? Bare minimum. So the wheel strategy in and of itself has a couple of different components. You've got covered calls, you've got covered puts, and you have the transfer of stock between covered calls and covered puts. So let me give you a very, very just basic example. So I buy, let's say I've got $10,000 in cash. Okay. And stock X, Y, and Z is trading at $100 a share. So I have cash. I haven't bought anything yet. I can start the wheel one of two ways. One, I can buy the stock and immediately go into covered calls if I want the stock at that price. I can go in another way and I can sell covered puts to acquire those shares at potentially a lower price when that covered put were to expire. Okay? I can buy the shares, run my covered calls, start generating premium, potentially look to get exercised and profit on those shares.
Sure,
effectively buying low, selling high.
Right.
I can buy lower with covered puts, hypothetically, and then sell higher once I obtain those covered puts for a cheaper price, obtain those shares through the covered puts for a cheaper price, and then I can go and sell them with covered calls. So how that process works, let's say I have a covered put at an $100 per share strike price. That would mean my $10,000 would get locked up, and let's say the premium is $200. And let's say the share price at expiration goes below $100 a share. That means I am going to buy that stock at $100 per share, because that's what I'm going to get exercised on from my strike price, my covered put strike price at 100. So I buy the shares at $100 a share. $10,000 goes into shares of stock out of my cash balance. And let's say the next week, now that I placed my covered put at a support, we bounce off of that support, which a support is another name for a weekly low that we had previously seen price action go to, or the share price go to. So let's say $100 was that support. We bounce off the $100, and the stock price is now at 105. So I acquired the shares at 100, and now the stock price has moved up to 105, which is a 5% change thereabout. So I can sell a covered call for 105 and hope to get exercise, where I would keep the premium from the call and the $5 per share profit, capturing that short and quick move. Or after I acquire the covered puts, or the shares through the covered put, I can sell those shares as soon as they go back up. I don't have to use a covered call. But the wheel process is going from covered puts, buying your shares, and then using the covered calls to sell your shares. That's the wheel process in and of itself. And then once my covered call sells my shares, hopefully for profit, as long as my covered call strike price is above my average cost. Okay, I bought my shares at 100. 105 is surely above my average cost. All right, so that's how I profit on the shares. And then as a seller, I get to keep the premium if I get exercise, no matter what.
No, absolutely. Now, you did just mention kind of the benefits about utilizing the wheel strategy and how it can affect, but how do you personally go about like winning and losing necessarily, if that were the case, when using the wheel, like using that strategy?
Absolutely.
Yeah.
So the way that I set my portfolio up is that I am doing both at all times. I am using covered puts with my cash that I keep on hand, because I always have cash on hand, all right? Cash is king when assets are cheap, okay? Cash is not king if you're not doing anything with it. Make that very clear. Inflation's what, 7.7% right now? So you're losing 7.7% a year. Baseline. Don't think too deep into it. Just know you're losing money. Cash is king if I plan to buy discounted assets with it, so that in the future that cash supersedes any kind of inflation that it would get hit with. All right? Because now it's not cash, it's an asset. So it makes me money. All right? Finance, Econ 101, whatever. Didn't go to those classes. Dropped out of college. So, when I win or lose, what's the deal? So, the winning is very easy with covered calls and covered puts. Because if the stock price goes up and I'm running covered puts, I win. If the stock price goes down and I'm running covered puts and covered calls, I win on the covered calls, and I might win all of my covered puts if it doesn't go down to my strike price and I don't get exercised. So I can win on both legs there. If the stock price stays exactly the same, or is at the same price where I set up the covered calls and covered puts at expiration, I win on both sides. Covered calls and covered puts. Okay? So if the stock price goes up, I win. If the stock price goes down, I win. If the stock price goes sideways, I win twice. Twice. Now, if the stock price stays in my range and goes up a little bit, I can still win on both. But basically, I'm setting up a bracket between the highs or resistances and the lows, the supports. And if it stays in that range, I win on both the upside and the downside. And if it goes up, I will close my covered puts for profit. Yeah. If the stock price goes down, I will close my covered calls for profit and then go add more covered puts, add more legs. And if the stock price goes up, I will close my covered puts, add more legs of covered calls.
Sure, absolutely.
So Stock price goes up, I win. Stock price goes down, I win. Stock price goes sideways, I win again. Now, let's talk about what happens if I lose.
Right.
So, if I were to lose the trade, the only way that I would lose the trade is if I have to buy back any of those contracts because I am in danger of getting exercised for a price that I don't want to get exercised on. Now, for covered calls, that would mean I'd be getting exercised on a covered call for a strike price that is below my average cost, which would mean I'd have a realized loss. I'll give you an example. If my average cost is 100 and I get exercised on a covered call at 95, I lose $5 per share. Not good, right? That's a loss.
Yes,
it's a
absolutely.
realized loss, especially if I let myself get exercised. So the alternative is, and make sure you watch the covered call and covered puts videos, okay? But the alternative is that I can roll them over to new and further out expirations for more premium to protect myself, give myself more time and more space. And I can do the same thing with covered puts. So I try to make sure that my leg-ins are spaced out enough to where I don't get exercised on either side unless I truly want to. And sometimes I still can't even get exercised. So I've been deploying a ton of covered puts recently, and I'm trying to buy up shares at these levels, and we just recently popped. So I was very close to in the money with those covered puts, collected a crap load of premium, and the market just ripped. So I was not going to let all that premium sit on the table. So I closed my covered puts for profit, got in covered calls since we ran up higher, and I needed downside protection to protect that move if we were to retrace. And I took home a ton of premium on the covered puts. I didn't get exercised. I didn't get my shares, but I'm complaining about making money right now.
I know.
Which is a good problem to have.
Absolutely.
It's a very good problem to have.
Absolutely. And you kind of mentioned this, you touched on this a few times basically, right? And how you're always running the wheel strategy. Can you talk a little bit about the benefits of running this long term and also running it short term? Like how they directly influence one another.
Absolutely. So let's talk about a short term deployment of the wheel. And let's talk about SPY. Everybody trades SPY. Everybody loves SPY. And it's just a beautiful ETF because it just does so well long term, and it's very consistent, and it's something that we all trust and believe in, except for Michael Burry. I don't know what it's going to take for him. Lost cause. Anyways, let's talk about SPY. So let's say I have enough money to run covered calls and covered puts on SPY, right? So SPY is currently trading around 390 something. So let's just say 390 for all intents and purposes, so my little brain can handle the math. 390 for 100 shares is $39,000. Okay, in the short term, let's say my covered puts got exercised. I bought the shares. SPY has a run up, and just recently it had a carry the zero. A $30 per share run up in some change, right from the lows up to where we're currently sitting. So a little bear market rally for the folks. All right, you know, we give the people what we want sometimes. So that $30 per share move on 100 shares is $3,000 in profit. Okay, that's a great move if you capture the whole thing. Let's say that you're just like me and you're not an absolute animal and you didn't capture the whole move and you didn't know exactly what the market was going to be doing like everybody else. And you captured $15. That's still a $1,500 per share profit when you bought the shares and then you sold the shares for profit. So let's say I got exercised on my covered puts in the short term. And this was a couple weeks long of run.
Yeah.
So I got exercised on my puts on the short term. And then a couple weeks later, we ran all the way up, flew to Valhalla. And I sold my shares for profit. That's the short-term benefit of getting exercised on covered puts. And then I could have sold a covered call, gotten exercised, and captured a lot of that move. I could have gotten exercised in the covered puts, bought the shares, and just sold the shares through a limit sell, no options, just sold them for profit. So that's the short term.
Sure, absolutely.
Let's switch gears.
Okay.
The long term is a little different. Now, more patience usually equals a little bit more reward, right? So let's say I buy SPY at 350, and a year from now, SPY's at 500.
It's a big number.
So I got exercise, and I'm hoping SPY's at 500 a year from now, or we're really just not, something's just not getting fixed, all right? I'm not going to go into it, but if we're not at 500 in a year, there will be a tear shed. One, I will be disappointed.
Slow motion, just slowly drop.
Right down the cheek.
Yeah, absolutely.
Right down the cheek.
You know.
Disappointment across my face.
And Dido playing in the background.
I love Dido.
You gotta feel better, man.
She's got a great voice.
I know.
Anyways. So 350, 12 months, let's say SPY's at 500. In 12 months, I captured a $150 per share move. What is that times 100? 15 grand. Okay, 15 grand.
Yeah.
Right? In 12 months, 15 G's. That's a good return. I can't do the percent return in my head, but it's a little less than 50%. Like 40 something. Okay?
Thereabouts.
So that's a phenomenal return on SPY considering it's not really a volatile asset and it doesn't move all that much.
No, absolutely.
But if I'm buying my shares low through covered puts and I wait for a little while and sell them, and if you sell them after the 12-month period, guess what you get? Guess what the IRS rewards you with? Long-term capital gains, which means that 15 grand is only taxed at 15%. I don't know how I lined up those two numbers, but 15 grand, 15%.
I think you're subconsciously thinking that. I think that's how that works.
Yeah.
Yeah.
So the IRS will reward you with long-term capital gains for being a long-term investor and not buying and selling stock in the short term, which I don't know. I didn't make the rules, but that's the deal. So that's a long-term benefit from running the wheel. And another long-term benefit from running the wheel is, let's say we started buying stock in January when the market started falling, and it's been falling ever since January of 2022, and we're going to get to January 2023 here in the next couple months. I have been running covered calls ever since and covered puts, and I've been generating cash flow every single month, and I'm able to buy more shares of stock at a discounted price the farther we fall. So basically, the wheel has provided me my own dollar cost averaging model within my own portfolio management model that I run. Double whammy. All right, shake and bake. All right, take it out the oven, shake and bake Ricky Bobby style. That's how we do it. Right? So that's how you benefit short-term and long-term.
No, absolutely. And I think this kind of goes without saying, but is there any other strategy that you necessarily prefer over the wheel?
No.
And why is that?
No. Because the wheel is phenomenal. It brackets your risk. You can trade the wheel daily, weekly, monthly, yearly, and you can make money whether the stock goes up, down, or sideways. Minimal risk, minimal effort, minimal time in the market daily to run this strategy.
Correct.
You can automate a lot of it.
Sure.
And my trades, even as a portfolio manager for businesses, my trades take an hour a day. I set some alerts up for the rest of the day in case I'm working on my computer or handling meetings, etc. But my trades take about an hour a day. An hour a day. And if you have a good bit of capital, that hour of day can equate to one heck of an hourly rate for you.
Absolutely.
Right? So if I make $1,000 a day and I spend 1 hour a day, that's disturbing. You do the math. I can't do it in my head. But that's one heck of an hourly rate. Okay? You're making a lot of money per hour.
Yeah.
Might as well be a lawyer. But lawyers work a little bit more than an hour a day. So, that being said, nothing against them. Gotta love them.
Yeah.
But if I make $1,000 a day and I work an hour a day, that's an incredible hourly rate. And the way that I scale that up is by running the wheel consistently, getting more capital under management, contributing more, reinvesting more, and then that wheel gets bigger and bigger and bigger and bigger, especially if you're using the right assets to trade it with. Now, I've run covered calls, I've run spreads, there's a lot of different things that I do. But in regards to cash flow for my portfolio management and for the businesses I manage assets for, my cash flow is very much derived from the wheel. And because it's consistent, right now I'm averaging about 3 to 4% per month on initial portfolio value, initial investment, in cash flow. Okay? You find me a rental property that's doing that. Just saying. I love real estate. The tax benefits are incredible.
Sure.
There are no tax benefits in the stock market except for long-term capital gains. Okay? For the most part. Do your research. But the cash flow that I'm producing is consistent. I can expect to do it month over month with a very small and tight range. And if I get exercised on shares and then sell them, those numbers only go up from there. Okay? That 3 to 4% average is based on me not getting exercised and me not buying and selling shares. If I buy and sell shares, it can go up tremendously.
Right.
And that's why I love the wheel.
And I think something that's very interesting that you touched on, there's a saying, right, of time in the market always beats timing the market. Well, with the strategy, you get a little bit of both.
Right. That's a great point. That's a great point. And with the strategy, like I said, it's not biased. You make money if the stock price goes up or if it goes down. You can buy shares when it falls. You can sell shares when it goes up. It is the ultimate bracketed protective strategy that really does force you to buy low, sell high, and gives you the dry powder to dollar cost average as the market falls, which is why I think it's just a truly elite strategy. And I started running it years ago. I've been running it for quite some time, and I've run so many other strategies in congruence with it, and I have just limited myself to that strategy as my generation of cash flow. And then I also have my dollar cost averaging, my buy-ins, my ETFs, my long terms. I have leaps that I use as well just to stretch my dollar further. And then with those leaps, which we'll do in another video, I can run something called poor man's covered calls. That's a whole nother video.
Yes.
And poor man's covered calls allow me to utilize an option deep in the money, so high delta, and sell calls against that, creating effectively a debit spread. So, but that in the money call acts as 100 shares. It's a fraction of the cost, and I can sell calls against it and generate cash flow off of an option rather than 100 shares.
But that's for another video.
Gotta stay tuned and stick around. So,
anyways, if you guys have any other questions that you'd like to ask, we do offer a live call, as mentioned prior, where you can talk to us every single trading day, Monday to Friday, from the start of the market. Please join us. We'd love to see you guys there. We'd love to have more people join and just help you as best we can. And as always, thank you very much for tuning in. We hope to see you like, comment, and subscribe. Any new ideas, any thoughts on what you're trading?
let's do business together, baby. Why not? I think it'd be a great thing to do, and we help our clients tremendously. We're young gentlemen. We have a lot to learn, but we've already learned a ton, and we're deploying it consistently. We've got the data to back it up, and we're making sure that everybody is truly appreciative and is growing alongside us so that they can achieve their goals in the fashion that they would like to and at an accelerated pace so that they can grow at the rate that they'd like to grow. So thank you so much for your time. As always, we appreciate you very much. Thank you for watching. Join us in the live call. Subscribe, like, comment, all the 9 that Josh always is so kind enough to say. And we'll see you next time.